Right now, over 800,000 UK homeowners are sitting on a ticking time bomb, and most of them have no idea it's about to explode. Mortgage rates are rising fast, landlords are flaying the market, and entire regions are seeing house prices fall for the first time in years. But while parts of the country are crashing, others are quietly booming, creating one of the most dramatic shifts in the UK property market in over a decade. Could your home be next? Or are you missing a once-in-a-lifetime opportunity that only a few people are seeing? This isn't just about property. It's about power, wealth, and who gets to hold on to both in the years ahead. Whether you rent, own, or are still waiting to buy, what's happening right now could cost or make you tens of thousands of pounds. Because what comes next might shock you. And it's already begun.
Number 10. Who wins, who loses? The UK property market isn't collapsing, it's splitting. And whether you win or lose in this shakeup depends entirely on where you stand. If you're a homeowner with a fixed-rate mortgage locked in for a few more years, you're in one of the safest positions. You can ride out the chaos, watch the market reshape, and avoid the pressure others are now facing. But if your deal is ending soon, you're stepping into a very different reality. Higher payments, tighter budgets, and difficult choices. For renters, it's a mixed bag. Rents are rising, supply is falling, but some landlords are exiting the market altogether. That means properties are becoming available for purchase, often below peak prices. If you've got a deposit and stable income, this could be the moment to stop renting and start owning. But only if you do the numbers. Desperation or FOMO will get you burned. Landlords are the most divided group of all. Those with large portfolios, good cash flow, and a long-term plan are buying more and taking advantage of falling prices. But the accidental landlords, the ones with one or two properties and rising costs, are checking out fast. Regulation, rising interest, and tenant protections are making the game too hard. They're selling, and in some areas, that's changing the market overnight. So who wins? The people who understand the game has changed. The ones who stop hoping things will go back to normal and instead adapt to what's happening right now. This market is rewarding patience, preparation, and cold-blooded analysis. The losers? Those who wait too long, act too late, or buy blindly without doing the math. If you're serious about staying ahead of this shift, hit that like button and subscribe. The market's evolving fast, and we'll make sure you're not left behind.
Number 9. The generational divide. The most brutal truth about today's property market? It's not hitting everyone equally. While younger buyers scramble to get on the ladder, many older homeowners are watching from a position of total financial security. In fact, if you're over 65 in the UK, there's a 61% chance you own your home outright, with no mortgage, no monthly payments, and no immediate worries about rising interest rates. Meanwhile, those under 45, especially people who bought during the boom of 2020 to 2022, are carrying the weight of the country's mortgage debt, and they're being crushed under the pressure. This isn't just about luck, it's about timing. Older generations bought their homes when prices were lower and rates were high but manageable. They've had decades for their homes to grow in value while their repayments shrank in real terms. Today's buyers, they're facing the highest price-to-income ratios in modern UK history, and they're being asked to pay 5% interest on homes that cost more than 6 or 7 times their salary. The result is a market where one generation is sitting on massive equity and passive wealth, while another is locked out, struggling to compete, or getting crushed under repayments. This divide is growing wider every year, and it's creating a quiet wealth transfer that's reshaping the property landscape. Parents helping kids with deposits, inheritance playing a bigger role in who gets to buy, and a system where your chances of owning a home increasingly depend not on your income, but on whether someone in your family already owns one. It's a two-speed market, and it's not just based on geography, it's based on age, timing, and access. And unless something changes, this divide is going to define the next decade of UK housing.
Number 8. What's next? Forecasts and future scenarios. Trying to predict the UK property market has always been a gamble, but right now, even the experts are divided. Still, one thing is becoming clear. While 2024 was the year of market paralysis, 2025 could mark the beginning of a slow and uneven recovery. Most major analysts are forecasting modest national growth of around 1% this year, with some regions, particularly in the North and Midlands, outperforming the rest. But it's the longer-term outlook that's raising eyebrows. According to Savills, we could see 24% cumulative growth between 2025 and 2029. That's nearly a quarter increase in average property values over 5 years. However, this growth won't be spread equally. London and the South may only see 15 to 18%, while northern cities could soar past 30%, especially in areas where demand is rising and supply remains tight. The logic behind these forecasts is simple. Wage growth is expected to average around 22% over the same period, which would give buyers more headroom to handle higher mortgage rates. The Bank of England is also expected to gradually reduce the base rate, potentially bringing standard mortgage rates down to around 5%. That's still much higher than the ultra-low rates of the pandemic, but it's manageable, especially with stronger incomes. As interest rates stabilize and confidence returns, transaction volumes are expected to rebound, and that will be the first real signal that the market is regaining momentum. Increased demand, particularly from first-time buyers and long-term investors, will start to put pressure on prices again, especially in areas where new construction hasn't kept up with population growth. In short, the market isn't dead, it's repositioning, and those who understand the direction it's headed may find themselves ahead of the curve before most people even realize the shift has started.
Number 7. A market in limbo. Collapse in transactions. Behind the headlines and price charts, there's a silent crisis playing out in the UK property market. A dramatic collapse in actual sales activity. In some months, transaction volumes have dropped by over 60% compared to the previous year. That's not just a slowdown, that's a near freeze. Buyers aren't buying, and sellers aren't budging. And it's creating a strange kind of standoff that's keeping the entire market in limbo. On the surface, property prices might look stable, but that's largely because there simply aren't enough transactions to shift the averages. What's really happening is a growing gap between what sellers think their home is worth and what buyers are willing to pay. Many homeowners are still anchored to the memory of 2021's peak prices. They remember what their neighbor's house sold for, and they're refusing to settle for less. Buyers, meanwhile, are nervous. They're worried about overpaying, about rates staying high, and about being trapped in negative equity if prices fall further. This stalemate means more properties are sitting on the market for longer, with repeated price reductions and fewer viewings. Sellers don't want to lower their expectations, and buyers don't want to commit until they're sure the worst is over. It's created a market where everyone's waiting and almost no one is moving. This frozen activity has knock-on effects. Surveyors are struggling to find comparable sales, making accurate valuations harder. Mortgage approvals are down, chains are falling apart, and estate agents in many regions are reporting the quietest months they've seen in years. The danger here isn't just price drops, it's market inertia. Without movement, confidence fades, and without confidence, even good deals get ignored. The result is a property market that isn't crashing, but isn't functioning properly either.
Number 6. The Help to Buy Trap. What was meant to be a lifeline for first-time buyers has turned into a financial trap for thousands. When the Help to Buy equity loan scheme launched in 2013, it promised to make home ownership more accessible by allowing buyers to purchase new-build properties with just a 5% deposit, with the government covering up to 20% of the price, or 40% in London. On paper, it looked like a win, but in reality, it steered an entire generation of buyers into a market segment designed to extract maximum value. And now the consequences are becoming painfully clear. Because the scheme only applied to new builds, developers quickly realized they had a captive audience. Prices were quietly inflated, often by 10 to 15%, to account for the government assistance. Buyers were told they were getting help, but many were unknowingly overpaying from the start. Fast forward to 2025, and a worrying number of these properties have not appreciated in value. In fact, many are now worth less than what buyers originally paid. Imagine buying a new build flat in 2017 for $250,000 with Help to Buy, only to discover it's now worth $230,000. After years of mortgage payments, you're left with negative equity, owing more than your home is worth. That makes refinancing harder, selling nearly impossible, and upgrading a distant dream. Worse still, the government's loan must be repaid based on the current value of the home, not what you borrowed. So if prices fall, your losses grow. This situation has left many trapped. They can't sell without taking a hit, they can't refinance easily, and because the new build premium is still a factor today, buyers are still walking into the same trap, often lured by slick showrooms and limited time incentives. It's a painful lesson in how short-term help can create long-term problems when market forces aren't carefully managed.
Number 5. First-time buyers, a rare window of opportunity. It might not feel like it, but for first-time buyers, this could quietly be the best moment in years to make a move, if they play it right. While rising interest rates and inflation have dominated the headlines, a powerful shift has been happening under the radar. Competition has collapsed. With transaction volumes down and many potential buyers sitting on the sidelines, those still in the market have something they haven't had in a long time: leverage. Sellers are feeling the pressure, especially landlords who are trying to exit the market or homeowners facing steep mortgage renewals. In some areas, properties listed at £300,000 just months ago are now being reduced to £285,000 or lower. That's not a minor discount. It's real money saved, and often without the frantic bidding wars of previous years. For first-time buyers with a stable income and a solid deposit, that's a huge shift in power. What's more, many of the homes hitting the market are ex-rental properties, well-maintained, in livable condition, and often in prime rental locations. These weren't available 2 years ago because landlords weren't selling. But now, with regulation tightening and profits shrinking, they're being offloaded, creating a wider selection and a rare opening for buyers who've been priced out for years. But this window won't stay open forever. As interest rates begin to stabilize and wages creep up, more buyers will re-enter the market, competition will return, and prices may firm up again. That means the advantage first-time buyers have right now is temporary. Still, it's not about rushing in, it's about being strategic. This isn't the time to stretch yourself or buy emotionally. It's the time to negotiate hard, do your research, and focus on value. In a cooling market, patience and preparation are the real keys to getting on the ladder without getting burned.
Number 4. Winners in the chaos, smart investors. While most people are pulling back, second-guessing the market, and waiting for some kind of normal to return, a small group of investors is quietly capitalizing on the chaos. These aren't the accidental landlords who stumbled into property ownership. They're strategic, data-driven buyers who see what others don't: opportunity in uncertainty. Despite the noise, buy-to-let mortgage applications surged by 32% in early 2025. That might sound surprising considering rising rates and tighter regulation, but it actually makes perfect sense. With thousands of landlords offloading their properties, many at discounted prices, savvy investors are stepping in and snapping up deals. They know how to run the numbers, plan for higher interest rates, and target areas where rental demand is surging. Take the North and Midlands, for example. In cities like Liverpool, Manchester, and Birmingham, investors are finding solid yields of 6 to 8%, even after factoring in costs. You can still buy a two-bedroom flat in Liverpool for under £120,000 and rent it for £800 a month. Compare that to London, where a £400,000 flat might fetch just £1,800 in rent, a gross yield of under 5%, and often much less after expenses. These investors aren't guessing. They're looking for areas with strong fundamentals, good transport links, universities, hospitals, and consistent tenant demand. They're buying below market value from distressed sellers, often with cash or large deposits, giving them leverage in negotiations. While others hesitate, they act, not recklessly, but with cold analysis and long-term planning. They understand that this moment in the market, where uncertainty reigns and many are too afraid to move, is exactly when the best opportunities appear. And as the dust settles, these are the players who have built the strongest positions. Not because they got lucky, but because they saw through the panic and moved when others froze.
Number 3, the Great Landlord Exodus. One of the most dramatic and underreported shifts in the UK property market right now is the mass exit of landlords. Last year alone, 19% of landlords sold at least one property, while just 8% bought. That's a massive imbalance, and it's only accelerating. Recent surveys show that over 40% of landlords are planning to reduce their portfolios or leave the market entirely in the next few years. The result? Rental supply is drying up. House prices are wobbling, and the rental market is being turned upside down. So what's driving them out? It's a perfect storm of economics and regulation. Mortgage rates have more than doubled, and landlords, many of whom are on interest-only loans, are suddenly facing huge increases in monthly payments. At the same time, new regulations are tightening the screws. The Renters Reform Bill is eliminating Section 21, meaning landlords no longer evict tenants without a clear legal reason. That sounds fair on paper, but from a landlord's point of view, it introduces more risk, more cost, and less control. Then there's the furnished holiday let crackdown coming in April 2025. Tax advantages that made short-term rentals profitable are being stripped away. For many landlords, especially in coastal or tourist areas, that's the final straw. The numbers no longer stack up, and they're getting out. This exodus is causing ripple effects. On one side, rental prices are rising as supply shrinks. On the other, the surge of former rental properties hitting the sales market is flooding certain areas with listings, especially in cities and commuter towns. These properties, often well-maintained and tenant-ready, are now being snapped up by first-time buyers or investors. It's a paradox. Renters are paying more than ever, even as house prices cool. And at the heart of it all is a landlord class that's saying, enough is enough.
Number 2, the mortgage time bomb. Beneath the surface of the UK housing market lies a threat that's quietly building, and it's about to explode. Over the next 2 years, around 800,000 homeowners will see their fixed-rate mortgage deals come to an end. These are people who locked in ultra-low rates during the era of cheap money, some as low as 1.5% to 2%. But as those deals expire, they'll be thrown into a market where the going rate is 5% or higher. And for many, that shift will be financially devastating. Let's put that into perspective. A $250,000 mortgage at 2% would have cost around $1,120 per month. At 5%, that same mortgage jumps to roughly $1,460 a month. That's an extra $340 every single month, or over $4,000 a year. And that's for the average borrower. For larger loans or households already struggling with energy bills and inflation, it's a breaking point. And that's the best case scenario. If homeowners don't remortgage in time, they could fall into their lender's standard variable rate, or SVR, which in many cases is now 7% or even 8%. At 7%, a $250,000 mortgage shoots up to $1,750 a month, a staggering $7,500 a year more than what they were previously paying. For many, especially those who bought during the 2021 to 2022 peak, this isn't just a financial inconvenience, it's a serious risk. They stretched themselves to afford a home when rates were low, and now they're staring down a monthly bill they simply can't meet. Some are already listing their homes out of necessity, while others are trying to hang on, hoping rates will fall in time. This isn't a future problem. It's already happening. And as more fixed-rate deals expire, a wave of forced selling could reshape the market, not just in price, but in ownership.
Number 1. Split market reality, North versus South. The UK property market isn't just slowing down, it's splitting in two. A clear divide has emerged between the North and the South, and it's becoming more pronounced with each passing month. In cities like Manchester, Liverpool, and Newcastle, house prices are still rising sharply, with some areas seeing growth of nearly 8% year-on-year. Homes are flying off the market within days, with bidding wars becoming common. But down in London and the Southeast, it's a very different story. Prices are stalling or even falling, and sellers are having to slash their expectations just to get a single viewing. The contrast is staggering. A 3-bedroom house in Newcastle might set you back around £180,000, while the same property in outer London could easily be £450,000 or more. But it's not just about prices, it's about value and quality of life. Someone in Manchester with a £200,000 mortgage is likely living more comfortably than someone in London with a £400,000 mortgage and a brutal commute. Affordability is driving the shift. While Londoners may earn more on average, the higher wages often don't offset the cost of living, especially when mortgage payments are double or triple those in the North. Add to that the rising cost of council tax, energy, and transportation, and suddenly staying in the South feels more like a burden than a benefit. Buyers are waking up to this. Many are relocating to areas where their money stretches further, and they're not just getting more space, they're getting a better lifestyle. The data backs this up. Property supply in London is up nearly 19%, but actual transactions are down 28%. That means more people are trying to sell, but fewer are buying. And when that happens, there's only one way for prices to go. The market isn't uniform anymore. It's diverging, and fast. The UK property market is no longer moving in one direction. It's splintering, reshaping, and revealing opportunities hidden beneath the chaos. Whether you're a buyer, seller, renter, or investor, what happens next could either cost you a fortune or set you up for serious gains, but only if you stay informed and move smart. The winners in this market will be the ones who understand the shift, not the ones waiting for things to go back to normal. If you found this breakdown helpful, don't forget to like this video, subscribe, and turn on notifications. We've got more insights coming soon.